Bonds and stocks are two key investment instruments that play a significant role in the financial markets. Understanding how these two asset classes interact is crucial for investors seeking to diversify their portfolios and manage risk effectively. In this comprehensive guide, we will delve into the dynamics of the bond and stock markets, exploring their relationship and the factors that influence their interactions. To comprehend the interaction between bonds and stocks, it is essential to grasp the fundamental characteristics of each asset class. Bonds represent debt instruments issued by governments, municipalities, and corporations to raise capital. When an investor purchases a bond, they are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount upon maturity. Bonds are typically considered lower-risk investments compared to stocks, offering a fixed income stream and a predetermined maturity date. On the other hand, stocks represent ownership shares in a company. When individuals invest in stocks, they become partial owners and have the potential to benefit from the company's profits and growth. Unlike bonds, stocks are inherently riskier investments as their returns are influenced by market dynamics and company performance. Stock investors aim to achieve capital appreciation and may also receive dividends if the company distributes profits to shareholders. The relationship between bonds and stocks is often characterized as an inverse correlation. In other words, when one asset class performs well, the other may experience a decline and vice versa. This inverse relationship is rooted in the concept of risk appetite and market sentiment. During periods of economic uncertainty or market volatility, investors tend to seek safer investments, such as bonds, as a means of preserving capital. This increased demand for bonds drives up their prices and lowers their yields, creating a favorable environment for fixed income investments. Conversely, when economic conditions improve and investor sentiment turns optimistic, there is typically a shift towards riskier assets, including stocks. In such scenarios, the demand for bonds may decrease, leading to a decline in bond prices and higher yields. This inverse correlation between bonds and stocks highlights the importance of diversification in an investment portfolio. By holding a mix of both asset classes, investors can potentially benefit from the performance of one asset class while mitigating the risk associated with the other. It is worth noting that the relationship between bonds and stocks is not always strictly inverse. There are instances when both asset classes may experience positive or negative performance simultaneously. Factors such as changes in interest rates, inflation expectations, geopolitical events, and macroeconomic indicators can impact both bond and stock markets simultaneously, leading to a positive or negative correlation between the two. Interest rates, in particular, play a significant role in influencing the bond-stock relationship. When interest rates rise, bond prices tend to decline, as existing bonds with lower yields become less attractive compared to newly issued bonds with higher yields. This decline in bond prices may result in a negative impact on stock prices, as higher interest rates can increase borrowing costs for companies, impacting their profitability and valuation. Conversely, when interest rates are low, bond prices may rise, leading to a positive impact on stock prices. Lower borrowing costs stimulate economic activity, benefiting companies and potentially driving stock prices higher. The interplay between interest rates, bond prices, and stock prices creates a complex relationship that requires careful analysis and consideration by investors. In conclusion, understanding the interaction between bonds and stocks is crucial for investors seeking to build a well-diversified portfolio. While the inverse correlation between the two asset classes is a common observation, the relationship is influenced by various factors such as market sentiment, economic conditions, and interest rate dynamics. By comprehending these dynamics and conducting thorough research, investors can make informed decisions and navigate the complexities of the financial markets.